Hello, everyone, and welcome to another NYAMB Education Series webinar. Today's topic is the VA lending opportunity, how to open new markets and exceed expectations with veteran borrowers. Today, we are hoping to get into the nitty-gritty on this program and teach you maybe a few things that you didn't already know. And for those of you who have not used this program before, I would invite you to listen carefully because this is one of the top lending programs in America today. Our host speaker today is Garrett Riley of Freedom Mortgage. A little bit about Garrett. Garrett currently serves as Vice President of Marketing, responsible for the wholesale division's product and marketing communication strategies. He brings 25 years of marketing and leadership experience with several large national financial services firms where he has held executive level marketing communication roles. Most recently, he served as Vice President of Wholesale and Retail Mortgage and Marketing Communications for New York Community Bank. And Garrett has held roles at AmTrust Bank, not to be confused with my company, AmTrust Mortgage. But prior to its acquisition by NYCB and NBNA America, he has served there as well. He is a graduate of the University of Notre Dame and Case Western Reserve University's Weatherhead School of Management. Everyone, would like to introduce you to Garrett Riley. Thank you, Garrett. Welcome.
Thanks so much, Mark. It's so great to be here with you, and I appreciate the opportunity to speak to your audience here today. And as you kind of alluded to, the plan today is to leave hopefully some real nice nuggets of information for everyone, regardless of your background with this program. We really tried to design this to have some nice takeaways. And Mark was good enough also. We met prior to really make sure we're baking in some things that are trends, particularly from a membership in New York. So we really try to listen and make sure we're bringing you the material that you need to be effective in the field. So with that, a couple other quick things for you. Obviously, we're excited to be here on behalf of the sales organization serving you in New York. John Turner is a great friend and leader here at Freedom. Appreciate the opportunity to partner with that sales team and his group in New York. Also with us on the phone today, and you'll hear from her a little bit later, is Teresa Wu. Teresa is one of our senior underwriters. She's on the firing line every single day working with this product, and I love to have her on, especially during the Q&A portion. Share some observations and some insights that she's seen that chances are you probably are experiencing every single day in your work, and hopefully that'll take away some insights for you. Again, we're privileged to be in front of you today as the #1 VA lender in the United States. It is so critically important for us to ensure that we're serving the VA borrower, and we're so honored to do so. Let's go ahead and jump right in. We have a lot of content to get through, and in the interest of time, I won't always get into all of the weeds, but we're going to cover everything from some of the key features from both a purchase and also a VA IRRRL perspective. We'll talk a little bit about the seasoning and forbearance issues you might be dealing with today. Some important changes that took place in 2020 around the Vietnam Veterans Act, Blue Water Vietnam Veterans Act, excuse me, that really creates some new opportunities, particularly for your jumbo borrowers that you may not be aware of. And if you are aware of it, you may not realize how flexible we are here at Freedom in supporting you with it. About some of the basics around entitlement, the VA guarantee and VA loan amounts and the implications for that in this program. And also we'll get to some frequently asked questions that we're getting, and also some that Mark is seeing in his market that also will be valuable for you today. So again, bear with me. I'm going to be covering a few different things, but I want to hit on some fundamentals, and then we'll get into some more of the complex issues in just a minute. But obviously, for some of you who are new to this program, obviously it's a purchase, a cash out, and the IRRRL, which of course has been the very popular choice and an option for your VA borrowers over the last year, as we've had unprecedented amount of volume and opportunities for that borrower. On the purchases, the max LTV take you up to 100%, which is an amazing feature, of course. Cash outs in a similar fashion take you up to 100%. Do encourage you to check out the rate sheet for any applicable loan level price adjustments that apply, but there's no loan limit on that. Again, on the VA IRRRL, no maximum LTV or CLTV, which is an interesting part of the program. Jumbo loan amounts, I alluded to this earlier. It's available with 100% LTV with no down payment. We're going to talk some more detail about that as to really how the benefit works for you on that, with your VA borrower. No monthly MI. That's a great feature, of course, and one-time funding fee is due at closing. We'll talk about that in a moment. On the ratio front, ratio for manual underwriting is permitted. That you've got that 43%. It's not to exceed the 43% DTI. A ratio greater than 41, though, will require 120% in residual income. Some of the guidelines here, just to make sure we're all on the same page around this, and these things have changed in recent months, so just to make sure we're all clear. For a non-freedom to freedom refinance, our minimum credit score is 580, a very, very competitive minimum score there. If you are working with an existing Freedom client, the Freedom to Freedom VA IRRRL has a minimum of a 550 credit score. If our minimum credit score is a 580 for purchases, conforming or jumbo transactions, and for those of you also servicing those who are interested in manufactured homes, there's a minimum credit score of 640. I also like to mention here, because this does come up as a benefit, particularly when you think about efficiency and working with your borrowers. You know, as a large servicer here, the net escrow payoff option for a freedom to freedom refinance, you can use those funds in the existing escrow and apply it as a credit toward the existing mortgage loan being refinanced, which of course results in a lower cash to close. I like to mention that just because, again, it's all about efficiency and providing that additional benefit to your borrower. We're doing a lot of things here at the company to continue to provide value, particularly on the pricing front. We have an ongoing quarter LLPA purchase incentive, which is in place for our government business as well as our conventional business. So I want to make sure you're aware of that. One interesting nugget that I think a lot of originators may be overlooking sometimes is this last one here, that if you're talking about a full doc VA purchase, in addition to paying customary closing costs, sellers may also contribute up to 4% of that loan amount for items such as paying off judgments, credit balances, gifts, prepaying taxes, and home insurance. So to be clear, that's almost like another bonus on top of the customary closing costs. So something that you may not realize, but it's a nice additional benefit of this program as you're considering structuring these deals for your customers. So let's talk about VA IRRRLs here, a quick snapshot for you to really understand the value for it. Now, the non-credit qualifying program here on the left-hand side is without question the flagship program for us. No verification of income or assets, no DTI calculation, mortgage-only credit check with scores. As I mentioned, the non-freedom to freedom program is a 580. The freedom to freedom is a 550. Again, that no maximum LTV, no appraisal, no 4506T, no verbal verification of employment. So talk about doing a program. It is probably the easiest program that you can offer. It is truly a checklist, almost like underwrite, and the requirements are very straightforward. So I just want to stress that point. Our processes here make it extraordinarily easy for you to get started on this transaction and get it into the approval queue very quickly. A couple other things I want to call out for you. You know, this streamlined refinance experience, I kind of alluded to this. We call it almost a checklist underwrite, because if you get these materials into us, I mean, you're really on your way. I mentioned the DTI requirements already, that not to exceed the 43 DTI. Anything over a 41's got that 120 residual income. You should be mindful of the fact that no mortgage payment delinquency is permitted within 6 months of the note date. The closing costs can be added into the new mortgage loan amount. And it's including the funding fee, which we'll talk about here in a second. The loan origination fee is a maximum of 1%. Also, please note that delinquent taxes cannot be included in the loan amount for this program. For VA IRRRLs, you need to be mindful of a number of key rules, and I just want to quickly touch on them for those of you who are somewhat new to this. There is the recoupment rule. For an IRRRL that results in a lower monthly P&I payment, the recoupment period of fees, closing costs, and expenses other than the VA funding fee, escrow, prepaid expenses, et cetera, incurred by that veteran cannot exceed 36 months from the date of loan closing. There's also the net tangible benefit rule. For example, if you're doing a VA IRRRL from a fixed rate to a fixed rate, that new loan's interest rate must be at least a half percentage point lower. If you're doing a VA fixed rate to an ARM, it must be at least 2 percentage points lower. I do get a number of questions about term reductions, which is also a very popular choice out there. If you're doing a fixed rate to a fixed rate IRRRL term reduction, the new loan's interest rate must be at least a half percentage point lower, and that PITI can increase up to 20% without credit qualifying. course, you need to meet recoupment guidelines as well. If you've got a higher payment, you should be mindful of the fact that for an IRRRL that results in a higher payment, we have to submit evidence to VA that the veteran has incurred no fees, closing costs, or expenses other than the VA funding fee, escrow, and prepaid expenses, et cetera. So seasoning is definitely a hot topic, and seasoning is definitely a hot topic here, and it's something that we want to make sure that you're clear on, and we'll touch on this in the context of forbearance in just a second. But the borrower must have made a minimum of 6 months of mortgage payments and the loan being refinanced. That's beginning after the date on which that first payment is due, and the note date of the refinanced loan occurs no earlier than 210 days after the date on which that first payment is due on the mortgage being refinanced. We'll touch some more about that in a moment as it relates to forbearance, because there's a lot moving in that area. We want to clarify really how that works in practice today, considering you have a lot of borrowers who are fortunately moving out of forbearance and want to make sure we're clear as to what the opportunities are for them. So I was alluding to how easy this program is before, and I wanted to kind of quickly go through just how simple our checklist and really what you need for this VA IRRRL program. It's the items on the left-hand side are the minimum requirements for getting this into the queue for an approval. What I encourage our clients to do, just think about all these things to come into us at once. If you can gather it all together in one single submission, just saves you time. You're not having the back and forth of having to chase down additional documents. You can break it out in two different parts of the process if you choose. I always like to encourage our clients to do it as a single submission. So it starts with that current payoff. That's plus the note or the current mortgage statement needed for the net tangible benefit calculation. This is new. The COE, or the Certificate of Eligibility, which is really the critical document that you need to ensure eligibility for this, is no longer required as a document for submission. We have other means by which to obtain that information in our processes. So I'm pleased to say that's just another simplified part of the process. One less document for you to have to chase down. The COE as a document is still required for us behind the scenes, but not something that you have to chase down and provide as you used to in the past. Fully executed 1003-92-900A needs to come in. The mortgage-only credit report with scores, that's for non-credit qualifying, or the full credit report if you're doing a credit qualifying IRRRL. The VA case number assignment and the loan comparison statement. On the other side here, if it's once you get to the final underwriting submission, you need to have that title commitment, homeowner's policy, and nearest living relative information. Again, very simple, very straightforward, truly one of the easiest programs that you're going to find. And you add that to the benefits. It's a program that if it's not as part of a central part of your strategy, you can hopefully quickly see why it should be. Here at Freedom, we've got a number of documents to help you through the process. We have checklists, we've got survival guides. So we're not going to go through the detail here, but just know that if you're working with our sales partners in the field, there's a lot of material to help you get up to speed quickly. And even if you're a savvy originator, just making sure that you're following our process in a very clear and easy way, we've got all the documentation there for you. I alluded to this earlier, but forbearance is obviously a hot topic. Let me take a couple minutes to go through some of the bullets to get us on the same page, and then kind of talk about some of the more recent questions that have come in on this topic. It starts off with the fact that periods of forbearance cannot count towards seasoning. However, the forbearance under the CARES Act does not alone cause any loan to fail to meet the seasoning standard. So it's important to know that if a loan met seasoning requirements before a veteran invoked a CARES Act forbearance, meaning 6 consecutive monthly payments were made, the seasoning requirement remains satisfied. Now, in a case where a borrower made 5 or less consecutive payments involving a CARES Act forbearance, the borrower would need to make 6 additional consecutive payments, that's post-forbearance, in order to meet the seasoning requirement. If there's any indication on the credit report or payoff that the borrower has previously been in a COVID-19 forbearance, that payment history is obtained from the current servicer to ensure the seasoning requirement has been satisfied. And again, all loans must meet the seasoning requirements and paid up to date. Now, these last 2 bullets are ones that I just want to call to your attention because these are ones that are reflective of really what's new or what the trends are today. As your borrowers are coming out of forbearance, and this is a Ginnie Mae rule, the loan has been brought current. In most cases, that loan is getting brought current using a loan modification. So with that in mind, the seeding requirement is 210 days from the first payment due date on the modification to the closing date on the new loan. And to clarify that point further, if the loan has been modified, even if seasoning was met before the forbearance, the seasoning period starts over from the date of the first payment under the modified terms. So we get a lot of questions about that in our group. Want to just call that out for you to make sure you're really clear how to navigate that, and also, frankly, set the right expectations for your borrowers. So let's talk a little bit about changes and understanding a little bit of background as the recent changes and how it affects this really attractive program. VA loan limits follow FHFA county loan limits, and the point that these limits are not a cap on how much your client can borrow. It simply has represented the loan amount that can be borrowed without a down payment. So veterans can qualify for larger loans and can exceed these county loan limits. Now, loan amounts exceeding the base conforming loan limits, per our definitions, are considered jumbo transactions. The exception being in Hawaii and Alaska, not applicable for this group, but in that area, there are slightly different rules. Now, prior to January 1st, 2020, all veterans who exceeded these base or high-cost loan limits were responsible for bringing in the additional loan amount in the form of a down payment. That was 25% of the difference between the loan amount and the county loan limit. But here's the great news as to what's changed. The president signed back in June of 2019, as I alluded to earlier, the Blue Water Navy Vietnam Veterans Act, which went into effect on January 1st of last year. So this act expanded that maximum guarantee amount for purchase and cash out loans, enabling your eligible jumbo borrowers in particular to exceed published county loan amounts without a down payment requirement. And that is significant. I want to stress again, you're exceeding those county loan limits without a down payment requirement. Now, that includes some rules to go along with it, one of which is subject to credit approval, of course, requires full entitlement. We'll talk a little bit more about entitlement in a second. And of course, it's for purchases and cash out refinances only. Now, this VA benefit enhancement, again, means that your jumbo borrowers may obtain no down payment VA-backed loans in all areas of the country for essentially any home price. I mean, that is a benefit you simply can't find elsewhere. Now, here at Freedom, we're really pleased to say that our usage of this program is to the full extent it can be. We have no jumbo overlays or loan limits. You should know that a VA jumbo loan that does exceed $1 million with 100% LTV will be subject to a little bit more due diligence before approval. But again, we don't have any special overlays for that. So it's a terrific benefit. In talking to our clients, it's something that is used frequently, and it's a terrific selling point as you're really just trying to create awareness for this program to begin with. So I hope that's a big takeaway for you today. So one of the things that changed, just want to quickly touch on this because it is important about the benefits of this program, is the funding fee update. And the table below does include all of those updates for you. Now, for the purposes of today's conversation, the VA IRRRL there at the bottom, that didn't change. It was at a half point, and that's for the first time use, and it remains a half point for any subsequent use. What you should be mindful of that for regular military, reserves, and National Guard, they're all now subject to the same funding fee percentage. And when we made these changes, the funding fee for the regular military actually decreased in most cases for reserves and National Guard. So that was good news when that change happened. A couple other quick reminders for you that the funding fee may be included in the loan amount, and that veterans who were injured while in service are exempt from paying the VA funding fee if they receive disability compensation or have a disability rating of 10% or higher. Surviving spouses of veterans who died in the line of duty also qualify for a funding fee exemption. Another important benefit that went into place last year that it's really important to talk about is for your Purple Heart recipients. This is another great opportunity for this very deserving borrower group. The Act amended the current regulations, which waive the funding fee if you are active duty and you provide the certificate of military orders of having been awarded the Purple Heart. That funding fee will be waived for you as well. So another great benefit for this particular VA borrower. let's go ahead and just kind of talk a little bit about something that is a point of confusion very often, especially if you're somewhat new to this, is the entitlement concept and really ultimately the role that that VA plays here. Now, VA, as opposed to lending money directly, essentially has provided a financial guarantee on these loans, which are made by private companies like Freedom Mortgage. Now, this guarantee is a type of insurance for lenders, essentially pledging to repay a percentage of the loan if the borrower defaults, which in this program is typically 25%. Now, this guarantee is reflected in a dollar amount, which is called entitlement. That's the core of the eligibility for this program. The borrower's amount of entitlement determines what they may borrow without a down payment. The calculation is determined during the origination process, and it uses that document I refer to as a COE. Those of you who do this all the time certainly know about this. Just be patient with me for a second because I just want to make sure everyone understands this key point. There are a couple layers of entitlement. You've got the basic entitlement, which is at $36,000. You've got secondary entitlement there, and then you've got the maximum entitlement in most of the country that applies to those county loan limits that I was referring to. Now, since the VA guarantees 25% of the loan amount, borrowers therefore can borrow up to 4 times their entitlement, which is in the current market, $548,250, and that's again in most parts of the country under 1-unit property. In high-cost areas of the country, qualified veterans can take advantage of even more entitlement, and that's up to $822,375 for 1 unit. So, as discussed, published county loan limits are no longer a factor for veterans seeking a jumbo loan with full entitlement. So, for veterans with full entitlement, the maximum amount of guarantee for a loan above $144,000 is 25% of that loan amount. To be clear, the county loan limits and possible down payment requirements continue to apply for those who have more than one active VA loan, only partial entitlement available, or those who have defaulted in a previous loan. So I've got a couple examples that I'll be leaving with you in the presentation that ultimately we'll be able to provide to you, but it's just important to understand that the old rules, so to say, still are in play in those circumstances. Now, if the COE shows any unrestored entitlement, or the loan amount is less than $144,000, as I mentioned, there's a regular calculation that still is used to determine if a down payment is needed, or if the loan amount needs to be lowered, or if the entitlement should be restored to receive that 25% guarantee. Again, for veterans who have previously used the entitlement and such entitlement has not been restored, the maximum amount of guarantee is the lesser of 24% of the loan amount or the maximum amount of guarantee entitlement available. Hey, I realize I just threw a lot at you. When you get the slide deck, obviously you'll be able to go through these bullets yourself, but this is the core framework just for understanding the benefit around this program. Now, I did provide a couple calculations here, which really tries to illustrate the real benefit here of the program. And I'll just quickly touch on a couple things on this slide, and we'll move on. But what you'll see here is because of these new rules, a situation where you had a home for say $600,000, where the county loan limit was $548,250, and you would normally have that down payment requirement coming in. In this case, it was going to be about a $13,000 down payment. That, because of the new rules, is no longer required. So a very attractive selling point for this type of borrower. The second scenario I have here for you, again, I'm not going to go through all the numbers right here, but shows you, okay, well, you are using some entitlement. In this case, it was an example of $70,000 in entitlement on a prior loan. And yes, there is going to be a contribution required. The punchline on this one is, yeah, you've got a down payment, but the point about the program still holds true, at least in terms of the program before January 1st, 2020, is the requirements are so much more favorable than any other program that you're going to find in the marketplace. Still a huge benefit, but on that prior slide, you certainly see the benefit of having that 100% entitlement and then not having any down payment whatsoever. A couple other quick things for you. I'm not going to go through all the bullets here, but there's a lot of content out there that's available to you if you're somewhat new to this. On the LGY hub that you'll be using gives you all the information you need about, getting such things as information about your COE or ordering the appraisal, and getting a view of your loan status or ordering the URL case number. So again, all this is going to be the hub that you'll be using to transact with that. A couple other quick notes for you. I talked about the COE. And the COE is still very important on the purchase transactions and you'll still need to provide it for, of course, the purchase transactions. The COE, however, for VA IRRRLs is not required. So just to clarify that point. But yeah, that COE is something you've got to be getting. And I strongly recommend that you must obtain that before requesting the appraisal. A couple other things here, here at Freedom, we'll initiate the CAVRS reporting system as part of our process. You will request the credit report and the verifications, and I just provided some of the details to kind of where you find some of those rules if you want to review them a little bit more yourself. Gave you a quick snapshot here of where that COE can be accessed, and a screenshot as to where you're going to be looking on the site to do that. Similarly, on the appraisal side, a couple reminders that the LE should be issued and the intent to proceed must be acknowledged by the borrower before requesting the appraisal. And then here at Freedom, we're enrolled in the Appraisal Processing Program, or LAP, which enables us the appraisal to go directly to Freedom for review. So a little bit of more of an efficient transactional process that allows us to go faster for you as part of this loan process. Couple quick other notes for you, and we'll get into some Q&A, but here at Freedom, we do offer a very robust disclosure program that really takes care of many of the things that you need to be concerned with from a disclosure perspective through DocuTech. Just gave you an example here on the slide. I'm not going to go through every single bullet, but all these shaded items are all handled through our DocuTech program. And again, just designed to make things easier for you. One less thing for you have to worry about as you're working through your origination process. Okay, so getting a little bit closer here to the end, and as we get to we'll open up the chat box, perhaps some questions, or we'll go live, whatever Mark's preference is. But I did want to just kind of touch on some key questions here that have come into us, and also that we want to address right off the bat. Are there manual underwriting options? And I did allude to this, of course, a little earlier, but the answer is yes, that refer with caution and manual underwrites are eligible on VA, provided the DTI ratios are satisfied and the borrower meets credit requirements. And that includes jumbo loans. So definitely an option for you, and a nice option. Questions about appraisal values. And the question is, are there really options if an appraisal value, if there's a concern on a purchase? And I want to kind of address that right up front for you. If a VA appraiser believes that the actual home value will be lower than listing price, they will invoke what's called Tidewater. And this is a special notification for the listing agent. And what it means is that within 48 hours, the listing agent will need to submit all the following: recent sales, a list of improvements or other comps to the underwriter and VA to have this evaluated. It's a unique option. You're not really going to find anything like this in other products. So we know that we get questions about these values, and there are remedies to try to address them, and this is an example of that. Also, there are some other changes I want to call to your attention that came into play, particularly as we turned into the new year, but also based on the experience we all had with COVID last year as well, that previously Guardsmen became eligible for VA home loans after 6 years of service. Now, in December of 2020, Congress passed the Veterans Healthcare and Benefits Improvement Act, which provided an exception for Guardsmen mobilized under what was called Title 32, which the order by the governor gained the VA eligibility, which is huge, after serving 90 days of full-time duty, provided at least 30 of those days were consecutive. Also, the change is retroactive. So Guard members who served long ago but fell short of the 6-year requirement could now be eligible for a VA loan. So in the context of, and I'm sure you have many of your colleagues and potentially yourself affected if you were called up in National Guard, variety of reasons, whether it be COVID support or the challenges in the Capitol earlier in the year, this is a program that has been modified to help that borrower. So really great news along that front. We get questions about renovation costs or energy efficiency improvements. Can they be added to the loan amount? The answer is yes. That's up to $6,000 for energy efficiency improvements. Documentation requirements will vary depending on costs. Questions on water tests. To be clear, the COVID-related VA flexibilities that you saw in 2020 have been discontinued. So exterior-only appraisals, cash out, VA to VA water test requirements have been restored. So for water tests, the borrower cannot draw their own samples. And as a reminder, borrowers are not required to hook up to public water if available and not required by your municipality. And finally, everyone's scared of termites. Obviously, that's a joke. If it is a termite inspection required, yes, it is. It is always required in a moderate to heavy, what's called tip zone. So those are some of the current trends out there, guys, that we wanted to bring to your attention. At this point, Mark, we're happy to open the mics or the chat box, whatever your preference is, and we're happy to address any questions. If we can also unmic Teresa Wu, who has also joined us from the underwriting group. Teresa, when you and I are presenting together, I always like to ask you if there's anything that you're seeing, kind of hot off the presses that might be of value to this audience. If the answer is no, that's fine. We'll just handle the questions from here on out. But I always like to give you an opportunity to see if there's anything that you'd like to share.
I guess just the loans that I've been submitted to me for underwriting, I'm seeing a lot of cash outs from people who had just done an IRRRL, but the rates are slightly lower now, but they're not the 0.5. So, or they're wanting to lower the term, and take advantage of a rate. So I'm seeing a lot of those, even though they've just refinanced, they want that cash out for the low rate. But they don't meet the 0.5. So I'm seeing a lot of that with their reason for cash out, just to invest it in the stock market, college, home updates, and with the appraisals, being higher now, cash outs are really coming in. So that's what I'm seeing. And yeah, if we get on into the values, along with the Tidewater, I just, of course I'm seeing that. But sometimes the appraiser, even after the Tidewater, he's going to bring it in at what he thinks it is. But there's still another option, which is the ROV, which is the reconsideration of value. So the borrower, the broker, the real estate agents, if they really feel like, hey, this is not right, there's this value is not right, and they still want to do the 100%, so they need a higher value since they want to do the 100%. We can submit that to VA, the same information as the Tidewater, and VA will look at it, and the appraised value doesn't change, but we can underwrite off of the value that VA assigns it. So VA may say, okay, came in at 400, I'm going to give you the 430 that your purchase price is, just because we think it's okay. And they take a lot of things into consideration, even the borrower's credit, or, just sometimes we don't really understand, but sometimes they won't increase it, but it is another option. And also another misconception when you were talking about, in today's market, the veteran can pay. They do the amendatory clause that says I have the option to back out, but I do have the option to proceed. So a lot of them are writing right in the purchase agreement while they sign the amendatory clause so that they can get the deal. I'm willing to pay $10,000, $20,000 over if the value comes in low, so that they get the seller to take their offer as opposed to a conventional one. So just, some of those misconceptions about VA limitations. So that's kind of what I'm seeing.
Thank you so much, Teresa. Those are interesting. Those are interesting perspectives. So yeah. Mark, at this point, I'll turn the microphone back to you, and we can proceed however you so choose at this point.
All right. Well, there's some questions here. Teresa, thank you for clearing that up about the amendatory clause, because so it seems that the borrower does have the opportunity to override the amendatory clause by saying, I'm willing, even though it's in there, I'm willing to pay more and will do so.
Yes, yes. And it's nice to, I can't tell them what to put in their purchase agreement, but I think if you're working with the realtors, to let them know, don't reject my VA offer. This veteran, he wants 100%, but he has the ability to put down 20%, so if the appraisal comes in low. And same as the repairs, we've seen it better. It used to be that the veterans could not pay for the repairs, but they can now if it's negotiated. So I'm also seeing that is that the veteran will pay for repairs because they're worried that, oh, this appraisal is going to be picky and I want a conventional appraisal, because the sellers are holding all the cards right now. So, the veteran can say, willing to pay this much, up to the repairs if VA requires it, if the appraisal requires.
That's really powerful. So it's incumbent upon us as the loan officer to make this clear to our realtor partners in this process that these things shouldn't hold up a veteran from getting a loan. This is better than FHA, where FHA does not allow the borrower to pay for these repairs. But I have a question on the points and fees. You brought something up. The seller can contribute 4% toward the borrower's debt reduction. So that was pretty interesting. Now, is there also an opportunity for them to get additional seller contribution toward closing costs, points, prepaids? There's a lot of confusion on the maximum contribution. So could you clear that up for us a little bit?
Yeah, so the seller can pay for all of the closing costs. And then in addition, the closing costs would be like the title, the lender's title policy, the origination fee, just the closing costs. Then the things that are not in the closing costs that are in the 4%, so they can pay all the closing costs. And then in addition, they can pay 4% of prepaids, funding fee, a television, they can pay off a judgment, like say the borrower has a $4,000 judgment that he just cannot pay off. It's a good selling tool, but I'm not seeing it much in today's market because, mostly you're seeing no closing costs or very few, but it is an option.
Right.
But it is an option.
We're not seeing a lot of concessions right now, but they'll be back. The market will turn the other way at some point.
Right.
So that's really good. So you can get all your closing costs paid for. And on top of that, and these are non-reoccurring closing costs you're speaking of. And then on top of that, 4% toward prepaids and debt reduction or debt reduction.
Yes.
Great. And veteran can pay for their own repairs, which is huge. So that was one question. Now, another question and let me just say to the members, you don't have to text me. You can put your questions right up on the screen here. But let me go through my text questions specific to the $6,000 energy efficient improvements. There are some detailed qualifiers to be able to obtain this. Maybe Teresa, you can answer this, because it's not just as simple as maybe just saying, I want a new furnace. Is there some additional qualifying for these?
Right. If you're going to do up to $3,000, you don't need, basically, okay, from 0 to 3 or whatever, you just need the invoice. Like, I'm going to get a new water heater, you get like the Energy Star rating, you're good to go. And amazingly, we see most of the energy efficients on the EARLs.
Oh, okay.
Yeah, because they want to pay off their loan, roll in their closing cost,
right,
and they want to then roll in the energy efficient. So we see that more on EARLs than we see on anything. And then from 3 to 6, you're going to have to get an energy report. They call it a HERS report to show how much you're saving. So the same thing, you have to show what you're doing, get your bid, and then you're, in addition, from 3 to 6, get the energy report to show that you're actually saving. It can't just be, I want a furnace, but my furnace is just, I need a new furnace, but it's the same energy rating. You have to show that you are really doing something that's going to save on your energy bill.
Right, exactly. Yeah, I encountered that recently. So thank you for clearing that up and providing a little detail on that. Another question that's coming up regarding the loan origination fee. I know the loan origination fee is limited to 1%. That's lender, broker, all part, anyone involved in the transaction, correct?
Okay, so the 1% is what the veteran can pay.
The veteran can pay.
Yeah, that the veteran can pay. So if you're going, and I don't know, like if you're going lender, okay, so most VA loans, EARLs and full doc do not go borrower paid.
Right.
They go lender paid. Yeah, but if you're going borrower paid, of course, if it's a refi, it's going to be that 1% of the loan amount, and that includes, when they say the origination fee, that includes what VA calls the junk fees, which is the entitlement settlement closing fee, not the title insurance itself, but they consider that. So really, you're not even going to get your 1%
Right.
because you have to back out any kind of fees. So, but if you want to go borrower paid and it's a purchase and you do have closing cost help from the seller can pay whatever. It's just what the veteran can pay is max 1%.
Oh, okay. So that could be earmarked. So
Yep.
that could, but the limit's still 1%, or would the limit be 2 or whatever?
The seller can pay whatever.
Any amount.
Yes, it's
Or
just,
loan
yeah,
origination.
VA doesn't care what the seller pays.
Okay.
So it's just what the veteran pays.
Yeah, but I think as a trend, many brokers find this program works best when they're doing lender pay.
Yes,
And makes
yes,
it easier on the veteran too, as well.
yes. Mhm.
Takes a little pressure off the program. All right, so let's see what else is on my screen. So, okay, so here's another question. It got a little complicated when you were explaining to us when someone had used part of their eligibility. Is there any way you could just quickly go back to that screen and give us this example again about how someone still has partial eligibility available to them? Okay, here you are on the screen now. So can you run
Sure.
through this for those who are asking?
You bet. You bet. And there's a lot here, so I'll make it try to do as clear as I can. But so the scenario here was you've got a veteran who has used, in this case, $70,000 of entitlement on a prior loan, and that may be a transaction from another property they've recently been transferred, what have you. It may not be restored, which means it's something that has to be considered here. And now they're purchasing a home, another property, in this case, a $875,000 property, where the county loan limit is $822 and change. So the math on this was, all right, well, then your maximum guarantee, as I mentioned earlier, was 25%. So that's $205,593. That's the number one thought. Number two, then you have to back out that entitlement that you have to consider here, and that's the $70,000 in the next line, which then says, okay, your maximum entitlement available to you to use in this transaction is now the $135,593. You multiply that essentially by 4, which then gives you what is your maximum loan amount with the 25% guarantee, and as a percentage of your what is your purchase price, you see that it's a guarantee percentage about 15.4%. So because the VA guarantee will be less than 25% in this kind of transaction, a down payment will be required, and that's how we get to you've got that 875 times the 25% gives the 218,750. You then back out that 135,593, leaving you that $83,000 down payment. So there's a lot of steps there, and I know it's a little bit lengthy there, but that's essentially the circumstance where you have entitlement that you have to contend with. And this scenario is the scenario that has been unchanged. Like this is the plain vanilla type of entitlement calculation. Teresa, I don't know if there's any more color you want to add to this, but this is really just intended to frame it against the new benefit, which is you've got full entitlement, and now you can proceed without a down payment at all.
Yeah, I ran into it on my last 2 loans. My loan yesterday evening, $3 million. The broker submitted it and at 100%. Well, he's got a rental property and it's secured by a VA loan. It's on his certificate. So he is very upset when I tell him you need $700,000 down. Or you need to sell that rental property. He said, oh no, the Blue Water Navy Act. I'm like, no, that only works when you have full entitlement. When you don't, it's back to this calculation. So, and then my second loan, this loan officer, he is very, he understood everything. So the borrower has his house for sale. This just maybe another sales tool or misconceptions. He had his house for sale, but he wanted to close before it was sold. So he's like, I'm just going to use the bonus entitlement. And so we did the calculation and he had plenty. So, you do have to understand this to, when you're taking your loan applications. And of course, if your loan amount, which you probably maybe won't see in New York, but here, if your loan amount's under 144, you can't even use bonus entitlement. It's only available for loans over 144. So that's what I see. Either they're trying to do it over and their loan amount's not 144, or they think that they can go as a jumbo, but they've used their, entitlement, and it's not going to be restored because in his case, it was a rental property on a different base that he was at in another state. And, he moved on to a different base, turned it into a rental property. And, so that's just, yeah.
Teresa, the only thing I was just going to add here is just for the benefit of those of you who are a little bit new to this, we don't have a calculator to offer you per se that, we promise is the tried and true calculator, but there are many out there. I'll say that. And for those of you who want to see this, and obviously we calculate it internally, as part of Teresa's department, but there are, if you go out there and you look, you'll see that there's many different types of calculation tools out there to get yourself a comfort level with this math.
Great. Thanks for that more detailed explanation. That became really clear about halfway through there. I guess I must have glanced. So
yeah, I don't want to turn this into the math that we all don't really want to talk about, but unfortunately it does come down to the math.
Well, it does, but here's something we should all be talking about is, again, for our members who aren't offering this program, boy, you really should be on top of this. This is a great thing that you can do, especially if you're not offering it now. It works for the mortgage broker. It works for the veteran. It works for the housing industry as a whole. There are so many more veterans now than there ever were before that have entitlement and could or should be using the program that are not. So I think it's great that you came out with this, Keith and Teresa, this Garrett and Teresa, regarding this program. This was really comprehensive. I appreciate it, so I'm sure our members do too. Did you have, I see you put on the screen here, your direct phone number for David Uri, who I've worked with in the past, and you have John Fuhrer up here and Regional John Turner. You got all the phone numbers anyone would need, any of our members, to delve into this further. And guys, I really appreciate the time you've spent with us today. For our members, I want you to please stay tuned to other notifications about webinars coming up as part of our education series. Also, please watch 2 weeks from now. We'll be putting up our course calendar for your continuing education. And also you can go onto our website at nyamb.org and look up the available time slots for private courses, which can be taught right in your office. So again, I thank everyone for attending today, and I'll look forward to seeing you all again soon. We are going to have a conference later on during the year. Please watch for information on that as well. Thank you very, very much. Appreciate it, Garrett. Teresa, have a great day.
Thanks so much for having us, Mark,
Thank you.
and best luck to everyone out there. Have a great day.
Thank you.
Bye-bye.